The average woman who reaches 65 today will live to around 87 years old, several years longer than the average man, and about 1 in 3 will live past 90. That single fact, that women simply live longer, quietly turns 6 ordinary retirement mistakes into expensive ones. Mistakes that a man might get away with, but that a woman pays for over many more years, very often while managing her money entirely on her own. Today we're going to walk through all 6, exactly why each one lands harder on women, and the specific, concrete fix for every single one. And we want to say something plainly at the start, because it matters. None of this is about blame. Women were, for generations, handed a harder financial deck. Many stepped out of the workforce to raise children or care for aging parents, which left gaps in their earnings record. Many were paid less for the same work across an entire career. And many were quietly steered away from the money conversations altogether. So if some of what we cover today hits home, it is not a personal failing. It's the predictable result of a system that wasn't built with a woman's longer life and different path in mind. What we can do is see the traps clearly and step around them, and that's exactly what this video is for. Here's the frustrating part, the thread that runs through all 6. Nobody sends you a warning. Social Security doesn't call to tell a widow she could be collecting more. No letter arrives explaining that the tax rules change the year after a spouse dies. The healthcare costs that Medicare doesn't cover don't announce themselves until the bill is in your hand. The system processes what's in front of it and moves on. And the person who ends up secure is the one who knew what to look for ahead of time. By the end of this, you will. And stay with us all the way to the 6th mistake, because it's the one that quietly undoes all the others if you skip it. You can get the first 5 exactly right and still be left stranded by the 6th, and it's the most preventable of them all. If you're not subscribed yet, take a moment and do that now, and turn on the bell. We cover exactly these kinds of things, the money decisions nobody sits you down to explain in plain English, before the mistake is made instead of after. All right. Let's get into it. The first mistake is claiming Social Security too early, and here's why it hits women harder than anyone. When you claim at 62 instead of waiting, you permanently lock in a reduced check. With a full retirement age of 67, claiming at 62 cuts your benefit by 30%, and that smaller amount is what you live on for the rest of your life. Now everyone faces that math. But remember what we said, women live longer. So a woman who claims early doesn't just take a smaller check, she takes that smaller check for more years than a man typically will, which means the lifetime cost of claiming early is bigger for her. On the other side, every year you wait past your full retirement age, up to age 70, adds about 8% to your benefit, permanently. Waiting from 67 to 70 can grow your check by 24%. For a woman who may well live into her 90s, that larger, inflation-protected check, compounding over a long life, can be worth a great deal. Now, we're not telling you to wait, because for some women, claiming early is absolutely the right call if you need the income or your health is poor. The mistake isn't claiming early. The mistake is doing it without ever seeing what waiting would have meant for you specifically. So the fix is simple. Before you file, open your My Social Security account and look at your estimated benefit at 62, at your full retirement age, and at 70, side by side, and make the choice with your eyes open. The second mistake costs widows enormous sums, and it's misunderstanding the survivor benefit. Here's how it works. When one spouse in a married couple dies, the survivor does not keep both Social Security checks. She keeps the larger of the two, and the smaller one goes away. Which means the higher earner's benefit, usually the husband's, effectively becomes the amount the widow lives on, potentially for many years alone. And this is where 2 mistakes happen. The first is during the marriage, when couples don't realize that if the higher earner claims early and locks in a reduced check, he's also permanently reducing the survivor benefit his wife will depend on after he's gone. The fix there is for the higher earner to delay as long as reasonably possible, precisely to protect the person likely to outlive him. The second mistake happens after. Social Security does not automatically move a widow to the higher benefit, and you cannot handle a survivor claim online. If she doesn't specifically call and ask them to review her survivor options, she can go on collecting her own smaller check, sometimes for years, leaving real money unclaimed. A survivor benefit can start as early as age 60 at a reduced rate and reaches the full 100% of what the deceased was receiving if she's at her own full retirement age. So the fix is a phone call. If you've lost a spouse, call Social Security at 1-800-772-1213 and ask them to compare both benefits and put you on the higher one. The third mistake is leaving money on the table that comes from a spouse's or even an ex-spouse's record. Because so many women have lower lifetime earnings, their own benefit is often modest. But you may be entitled to more through a spousal benefit, which can be worth up to 50% of your husband's full benefit if that's higher than your own. And here's the one almost nobody talks about. If you were married for at least 10 years and are now divorced, you can claim a benefit on your ex-husband's record. It does not reduce his benefit by a single penny. He is never even notified. And you don't need his permission or his cooperation. As long as that marriage lasted 10 years and you're currently unmarried, that door is open to you. Countless divorced women have no idea this exists and quietly collect far less than they're entitled to. The fix is to call Social Security and specifically ask them to check whether a spousal or a divorced spouse benefit would pay you more than your own. The fourth mistake is underestimating what healthcare will actually cost, and this one is sobering, so we'll pair it immediately with what to do. According to Fidelity's most recent estimate, a single 65-year-old retiring today can expect to spend an average of about $172,500 on healthcare over the course of retirement, and that figure does not include long-term care. Now layer in the reality for women. Roughly 7 in 10 people turning 65 will need some form of long-term care in their lives. And because women live longer and more often outlive the spouse who might have cared for them, they tend to need that care longer and more often have to pay someone for it. And here's the piece that catches people off guard. Medicare does not cover long-term care. Not assisted living, not a long nursing home stay, not ongoing help with daily living. People assume it does, right up until they need it. So what's the fix? Because we don't leave you sitting in fear. First, simply knowing this lets you plan, budget for healthcare as a real, large expense, not an afterthought. Second, if you're still working and have access to a health savings account, it's one of the most tax-advantaged ways to set money aside for exactly these costs. Third, look into whether long-term care coverage makes sense for your situation, ideally in your 50s or 60s when it's more affordable. And fourth, understand that for those with limited assets, Medicaid does cover long-term care, and there are legal ways to plan for it, so talking to an elder law attorney once can be worth a great deal. The fifth mistake is walking into the widow's penalty without seeing it coming. This is one of the cruelest quirks in the whole system. The year after a spouse dies, the survivor usually has to start filing taxes as a single person instead of jointly. And single tax brackets are much narrower, which means the same amount of income can suddenly be taxed at a higher rate. On top of that, Medicare has an income-related surcharge called IRMAA, and its income thresholds for a single person are far lower than for a couple. So a widow can find that the very same household income that was fine before now pushes her into higher taxes and a higher Medicare premium at the exact moment she's also lost one of the 2 Social Security checks. It's a financial gut punch layered on top of grief. The fix here is to plan ahead while both spouses are alive. This is where sitting down with a tax professional or a fee-only advisor genuinely pays for itself. Looking at strategies like drawing down certain accounts earlier or doing partial Roth conversions in the lower taxed years so there's less forced taxable income later. And if a life-changing event like the death of a spouse has cut your income, there's a form called the SSA 44 that lets you ask Medicare to base your premium on your current lower income instead of a past year. Most people never file it. You can. And the sixth mistake, the one we told you to wait for, is the one that quietly undoes all the others. It's staying disengaged from the money. For a lot of couples, one person, often the husband, handled the investments, knew the advisor, kept the passwords, understood where everything was. And it works fine, right up until it doesn't. Until he dies or becomes seriously ill, and his wife is suddenly expected to manage a financial life she was never fully shown, on the worst week of her life. We've seen women who couldn't even log into the accounts, who didn't know what they owned, who had no idea who the financial advisor was. You can do everything else on this list correctly and still be left stranded here. So this is the most important fix of all, and it costs nothing but a few afternoons. If you're the one who's been less involved, start now, while there's no crisis. Sit down together and make a simple list of every account, where it is, and how to access it. Know the name and number of any financial advisor. Check the beneficiary listed on every account and retirement plan with your own eyes, and update anything out of date. Make sure important accounts are either jointly owned or have you named, so nothing freezes if something happens. And consider setting up a trusted contact at your bank. This isn't about distrust between spouses. It's about making sure that whichever one of you is left can actually stand on solid ground. Knowledge is the one thing no one can claw back from you. So let's bring all six together. 1. Don't claim Social Security early without first seeing what waiting would mean for you, because your longer life makes that choice bigger. 2. Understand the survivor benefit, protect it during the marriage, and after a loss, call and ask to be moved to the higher check. 3. Check whether a spousal or divorced spouse benefit, even on an ex from a marriage that lasted 10 years, would pay you more. 4. Plan for health care as the six-figure expense it is, and remember Medicare won't cover long-term care. 5. See the widow's penalty coming and plan for it while both spouses are alive. And 6. Get fully involved in your own money now, because that knowledge protects everything else. Here's the thought we'll leave you with. Every one of these mistakes is quietly built on the same assumption, that someone else will handle it, that it'll work itself out, that there'll be time later. For a woman who may well live into her 90s, later is a very long time to live with a decision made without the full picture. You don't need to become a financial expert. You just need to know what to look for and which questions to ask. And now you do. That's not a burden. That's power. If this helped you, please share it with a woman you care about, a sister, a friend, a daughter who's planning ahead, because these are so much easier to get right early than to fix later. One conversation could change someone's entire retirement. Subscribe so the next one reaches you in time, and we'll see you in the next one. This is the Retirement Wire.